Today's CPA quick review is all about deferred tax assets and deferred tax liabilities. This is one of the most confusing topics because students often memorize journal entries without understanding why they're being recorded. Once you understand the logic, the journal entries become much easier. Let's start with the big picture. GAAP income is not always equal to taxable income. Book income is the income reported on the financial statements, while taxable income is the income reported on the tax return. Whenever those two numbers differ, ask yourself why. The difference will either be a permanent difference or a temporary difference. Permanent differences never reverse. Since they never reverse, they never create a deferred tax asset or a deferred tax liability. Permanent differences only affect the current year's taxes. Common examples include municipal bond interest, life insurance proceeds, fines and penalties, certain meals and entertainment, and life insurance premiums when the company is the beneficiary. If it never reverses, stop thinking about deferred taxes. Temporary differences are completely different. Temporary differences reverse in future years. Because they reverse, they create either a deferred tax asset or a deferred tax liability. This is where the CPA exam spends most of its time. Now remember one formula because it ties everything together. Income tax expense equals current tax expense plus or minus deferred tax expense or benefit. Another way to think about it is that current tax expense is what you owe the IRS today, while deferred tax expense represents taxes you'll either pay or save in the future because of temporary differences. Let's first talk about income tax payable, also known as current tax expense. This is the easiest number to calculate because it is based on taxable income, not book income. Simply multiply taxable income by the current tax rate. Income tax payable represents what the company owes the IRS right now. Now let's move to deferred tax liabilities. A deferred tax liability means the company pays less tax today, but will pay more tax later. Think of it as borrowing taxes from the future. The government lets you pay less today, but eventually you'll have to pay it back. A simple memory trick is this. If the tax deduction happens earlier than the book deduction, taxable income becomes lower today. Lower taxable income means lower taxes today, which means higher taxes later. That creates a deferred tax liability. Common examples include tax depreciation exceeding book depreciation, installment sales, equity method income, and prepaid expenses deducted early for tax purposes. For example, suppose book depreciation is $20,000, but tax depreciation is $30,000. Because tax depreciation is higher, taxable income is lower. The company pays less tax today, so it creates a deferred tax liability. The journal entry is straightforward. Debit deferred income tax expense and credit deferred tax liability. You're recording the future tax you'll eventually owe. Now let's discuss deferred tax assets. A deferred tax asset means the opposite. The company pays more tax today but will pay less tax in the future. Think of it as prepaying taxes today and receiving a tax benefit later. The easiest memory trick is this. If the tax deduction happens later than the book deduction, taxable income is higher today. Higher taxable income means higher taxes today, which means lower taxes later. That future tax savings creates a deferred tax asset. Common examples include warranty liabilities, bad debt expense, accrued liabilities, and other book expenses recognized before they become deductible for tax purposes. Suppose a company records a $12,000 warranty expense for financial reporting. For tax purposes, however, the deduction isn't allowed until the warranty claims are actually paid. Book expense happens first. Tax deduction happens later. Since taxable income is higher today, the company pays more tax today and receives a future tax benefit. That creates a deferred tax asset. The journal entry is debit deferred tax asset and credit deferred income tax benefit. Notice that with a deferred tax asset, you're recognizing a future tax savings rather than a future tax obligation. Students often ask how to know which number belongs in income tax payable and which belongs in deferred taxes. Here's the easiest approach. Always calculate income tax payable first, using taxable income multiplied by the current tax rate. Next, calculate the temporary difference and multiply it by the enacted future tax rate to determine the deferred tax asset or deferred tax liability. Finally, combine the two pieces to arrive at total income tax expense. Now let's talk about patterns instead of memorizing examples. There are 4 patterns that cover almost every CPA exam question. Pattern 1. Financial statement income comes first and tax income comes later. Examples include installment sales and equity method income. This creates a deferred tax liability. Pattern 2. The tax deduction comes first and the book expense comes later. Excess tax depreciation and prepaid expenses fall into this category. This also creates a deferred tax liability because taxes are lower today. Pattern 3. Financial statement expense comes first and the tax deduction comes later. Warranty expense, bad debt expense, and accrued liabilities belong here. These create deferred tax assets because taxes are higher today. Pattern 4. Tax income comes first and book income comes later. Unearned or prepaid revenue taxed before it's recognized for book purposes falls into this category. This also creates a deferred tax asset. Another topic tested frequently is valuation allowance. Just because a company has a deferred tax asset doesn't mean it will actually benefit from it. If it is more likely than not that the deferred tax asset won't be realized, the company records a valuation allowance. The journal entry is debit income tax expense and credit valuation allowance. The allowance reduces the value of the deferred tax asset reported on the balance sheet. Finally, remember which tax rate to use. Current taxes always use the current year's tax rate because that's what is owed today. Deferred taxes use the enacted future tax rate expected to apply when the temporary difference reverses. Never use a proposed tax rate, an expected tax rate, or legislation that hasn't been enacted. The CPA exam wants the enacted rate only. If tax rates change, remeasure the deferred tax asset or deferred tax liability using the new enacted rate. Compare the new required balance with the existing balance and record the difference as deferred tax expense or deferred tax benefit. Let's finish with a rapid review. Permanent differences never reverse and never create deferred tax assets or deferred tax liabilities. Temporary differences always reverse and create deferred taxes. Deferred tax liabilities mean you pay less tax today and more later. Deferred tax assets mean you pay more tax today and less later. Income tax payable is based on taxable income using the current tax rate. Deferred taxes are based on temporary differences using the enacted future tax rate. And finally, remember this simple phrase. Tax deduction first equals deferred tax liability. Tax deduction later equals deferred tax asset. If you remember that relationship, you'll solve most deferred tax questions with confidence.